Hello everyone, my name is Rafael and I'm the presenter on the How to Start Trading educational series here on Money Markets channel. Today we're going to have a look at the second episode from the series. As you have seen in the beginning of the video, we had a quick recap on what was discussed in the previous video, which is a very important one, which majority of people are not speaking about, unfortunately, these days. So I would encourage everybody before watching this video to go back and see that video first before coming into this one. So on this one, we're going to have a look at mostly understanding the market, what are the key components of the market, and understanding what is leverage, how it's being used, and how you can calculate the margin of your trading. And as well as we're going to cover what are the swap rates and how they are calculated, as well as in the end, of course, what are the main mistakes retail traders make when trading under those conditions with the leverage, and how they misuse it into their disadvantage. Starting off with the key market components, which is very important to understand. Firstly, we have the US dollar. As you know, currently it's still the world reserve and trade currency in the financial markets since World War II. Okay, so the majority of instruments that we trade, their values measured in US dollars, and it's the most important, let's say, currency or index that it really impacts the majority of the market dynamic and cycles. Secondarily, we have the yen, okay, which it could be used and used to be also a safe haven currency in certain dynamics and situations of the market, especially when there is uncertainty. You will tend to see that the dollar yen drops sharp, as well as with big spikes in the gold in some of those dynamics. So it's still considered to be a safe haven currency together with the gold. Then thirdly, we have the indices, the stock market indices, such as the S&P 500, the Nasdaq, let's say the US 30, Dow Jones, right? And what is the relationship to the overall market dynamic, right? So it's very important to understand the indices cycles, how they do impact the rest of the market, and when they do drop or go up, what can cause the rest of the market to do. Okay, and this is very important as well in combination with understanding the currency crosses. We will have a look which are the crosses in the next slide. So the crosses, in many times when they could hint to us when we should expect a changing market dynamic or cycle. They're actually one of the bigger clues that we can look in the market in towards finding out the next possible bigger reaction. However, in this video, we are not going to go into too much detail on those, because those will be covered extensively within our Priority Plus service, which we're gonna launch soon in my live sessions especially. So those that really want to understand those in more details, they will be able to have those educational sessions with me in the service. So here is the Forex market, more or less the breakdown of the main pairs we are actually looking or trading the most. I'm not covering here any exotic pairs, because those are not very frequently traded amongst traders, and plus they are actually quite illiquid in most of the cases. So we're going to have a look at the pairs that are mostly traded within traders around the world. So starting with the major FX pairs, okay, you can see that the major FX pairs are all connected to the US dollar. We have the euro against the dollar, pound dollar, Aussie dollar, New Zealand dollar, dollar yen, dollar CAD, and dollar Swiss. Okay, and then from the minor FX pairs and the yen pairs, we have euro yen, pound yen, Aussie yen, New Zealand dollar yen, CAD yen, and Swiss yen. Now, for the crosses, which I have mentioned previously, those are the main crosses we are looking at, the Euro Aussie, the Pound Aussie, and the Euro Pound. Now, those three here, okay, those have a very highly correlated impact in towards changing market dynamics, which they can also impact the trajectory and the movement in the indices and in other instruments. They are very important for the market. Not many traders or analysts understand the importance of those. However, we do understand them, and we know very well how they can impact a highly volatile market or changing market dynamic and unexpected spikes or turns in the market. So they are very important for us. And once again, for the people that will be in our Priority Plus service, you will be able to understand in detail how do those pairs impact the rest of the market and many times the indices as well. Now, for leverage, what is leverage? We have to understand that. And how do we calculate the margin that we need in the account based on the leverage which we need to open certain positions? Leverage, but what it is basically in simple terms, it's purchasing power that you have from the market, from the liquidity providers, in order for you to be able to afford opening certain positions in the market. What it is basically is lending money to the trader, okay, to open those positions. For example, it's similar if you can correlate this to you getting a mortgage from the bank to afford to buy a property, let's say, right? So as we said, liquidity providers lend this money. Okay, so you are able to afford opening certain positions. Okay, so essentially the trader is borrowing money from the liquidity provider to open those positions. This is very important to understand. Now, consequently, you have to be able to understand the contract sizes in the Forex market and what is the calculation of the required margin you need to know. Here on the right side is a screenshot from my MT5 account. On Euro Yen, for example, it can be any Forex market, and I have highlighted the contract size. As you can see, is 100,000 euros. This can be any currency, dollars, pounds, by the way. You can open any currency account you want with One Royal, our main pattern broker. The link is in the description, and we also have a cashback program for our traders that they sign up with our link in the description. So this is what you're gonna see. Okay, on the contract specification from the MT4 or MT5, it's always 100,000 units to any currency that you're gonna see. All right, and this is very important because for one lot, basically, this is the contract size, 100,000 euros. So on the next slide, we're gonna have a look at how do we calculate the required margin that we need in the account to open this one lot, and of course we're gonna have a look at what is the minimum size we can open and so on and so forth. So here is the calculation, okay, and our recommendations for the Forex margin calculation. We basically get the contract size and we divide that by the leverage. So for example, if the leverage is 1 to 30, which is the maximum recommended for any beginner retail trader, for one lot, okay, you will need 3,333.33 units of any currency to open this position, because you take the contract size and you divide it by leverage. So the contract size on Forex, it's always 100,000. Divide by 30, which is our leverage in this example, we get this figure right here. Okay, it's very simple, very straightforward for you to calculate this. And plus there are also there are also margin calculators and profit calculators with our main partner broker, One Royal. If you sign up with them, you will have access to a free calculator from their website in case you want it to be more easy. But again, it's very easy to calculate this manually as well. Now, for every 1 pip the market moves, okay, I will gain or lose 1 unit of my account's currency. This is why it's very important to understand the lot size you are opening, okay, and you will see in a bit why most retail traders make the mistake and over leveraging their accounts. Now, in the end, we have also included here what is the formula for calculating the required margin for other instruments rather than Forex, because on other instruments the contract sizes, they are different, okay? They are not the same with Forex. So when you go to their specifications, you will see what is the contract size for other instruments. So in this case, you will still take first the contract size. Then you have to multiply that by the current market price and divide that by the leverage to get the required margin you need for other instruments rather than Forex. Okay, very simple, very straightforward. Now, the lot size, it always starts from 0.01. In those examples, we are using one round lot just for the default, so you can understand easier the calculation. We do recommend, okay, for complete beginners, retail traders, between 1 to 10 and 1 to 30 leverage, okay? And this is for a very simple reason. If you are a beginner or you don't have extensive experience in trading, right? You haven't been able to have, let's say, good track record or anything like that. This is mainly because of your risk management and mainly because of your psychology, which is in the wrong mindset. Okay. Now, if you are using a highly leveraged account, automatically you think that you can open more positions because you have a bigger buying power, and you don't think of the negative consequences in case you are wrong, and basically how easy it is for you to lose your account. And this is why we recommend this smaller leverage. It's much better for you if you want obviously to open more positions. It's better for you to have a bigger sorry, it's better for you to have a bigger deposit into your account so you can stay in track, okay, of your positions. And there is a very good reason why regulators they try to limit the leverage provided to the retail traders. It's because when you don't have experience, it's very easy for you to lose money on the highly leveraged accounts, and it's much better for you to use a smaller leverage. Because the market, when it moves frequently, you tend to overreact, especially if you are looking at smaller time frames. And if you have over leveraged your account, it can either cause you stress or it can cause you more confidence that you should have in the market. And this is how you end up doing the mistakes eventually over time. Now, for highly experienced traders, they can go from 1 to 50 to 1 to 100, okay, which they know what they're doing. Obviously, for any case, it's recommended that traders, they use stop losses. You should always know before you enter a trade where you are planning to exit, whether it's in profit or a loss, okay? And you should not let your losing trades run over time, because eventually, again, you will end up in a bad situation. Now, for highly experienced, they can go 1 to 50 to 1 to 100. I personally use 1 to 100, but again, This is for people that they really know what they're doing. They have traded for several years. They can be considered as some sort of professionals as well. So they can go 1 to 50 to 1 to 100. Obviously, in the trading industry, we see many people going for 1 to 1000 on Forex, some of them 1 to 500 in certain cases. But the problem is they don't understand how leverage works, and they over leverage their accounts, and they can easily blow up their accounts this way. So this is not what we like to educate our clients and traders to do. So this is the ranges that we recommend. Now, for the swap rates, right? So what is the swap? It's very important to understand where it's coming from and why it exists. So, swap is the interest that the trader pays or gets paid for holding position or positions for the rollover period of the next trading day. The swap rates, they normally depend on currency interest rates, okay? And the trader basically is sorry, this is wrong, is borrowing money, okay? Since the trader is borrowing money from the liquidity provider, okay? He needs to pay, or he will get paid this swap. Now let's see an example here from euro dollar. Okay, so I have highlighted swap long and swap short. So swap long, it means if we are buying euro dollar, okay, and we hold this position for the rollover period of the next day, which is after from 10 p.m. GMT time when the market closed, we will pay 6.616 for one lot of holding this position. And from the other side, if we are holding a sell position, swap short, we will make, in this case, 2.2186 euros for holding that position. So, of course, if you are using a real broker in a real market, you have also positive or negative swap rates. So this is why I'm showing to you that so you can understand it. And on Wednesdays, we have the triple swap because it needs to cover the 2 days of the weekend. Now, one very big mistake many traders are doing, they are actually worried about swap rates, and sometimes when they are in good trades, they close them before the day ends because they don't want to pay the swap rate, for example. But obviously you can see that it really depends on which side of the market you are holding the position. And also, if you are cutting your positions short, I mean, if you are in a good trade that you are expecting, let's say 300 to 500 pips, the market is not going to give you that in one day. And what happens most of the time is that retail traders, they close their positions. The next day, they come back to the market, they take the other side, and they end up in the wrong side, and they blow up their accounts and lose their money just because they are worried about the swap rates, which obviously, if you are an experienced trader and you know what you are doing, you shouldn't be even bothered with the swap rates because over the long run, this is peanuts in comparison to your net profit that you could potentially be making. And this is just a retail trader's fallacy that they are worried about the swap rates. Obviously, that depends if you are trading with the wrong broker. Okay, that's a totally different case. But if you are trading with a real broker, obviously, those rates, they should be according to the currency interest rates, the liquidity provider, and stuff like that. And if you are in good trades, you are actually destroying your risk to reward ratio. If you had a good one, you're going to have a bad one, and over the long period of time, you will end up losing money, like 90% of the retail traders over the year. Okay, so again, this is not something that you should be worried. It's just there because we are borrowing money to trade. Okay, so of course it's something like you can say it's the cost of doing business. In other words, okay, if you know what you are doing, okay, you shouldn't worry about that. You can also make money in certain cases, as you can see, if you are holding certain positions. If you don't know what you are doing, that's another story. That's why we are offering our services. okay, for the traders. Get the real education from professionals so you can understand the market better and you know what you are doing. All right. And to conclude in the end, we will have a look at the retail traders' mistakes. We have already covered some of them, but this is to sum up everything. They are over leveraging their accounts. They have the wrong mindset, right? They are thinking that they can change their life with one or two trades. They don't understand the consequences. And most importantly, they tend to reinforce bad trades and bad trading ideas. They also follow, unfortunately, the wrong educators or mentors, fake Forex trading gurus that you see all over the place these days. And they also trade with the fake market brokers, bookmaker brokers. We have covered some of them in the first episode. You can have a look at the channel for the first one to watch it again. And they are looking for the easy way, which doesn't exist. They are looking for EAs or robots or copy trading or something like that. So it's very important to understand that trading is not easy, as some people may try to convince you. However, it can become easier, and you can understand the market if you follow the right educators, the people that have been working in the industry for a long time. And they do have good knowledge of the market, and you can get very good analysis and mentorship over the long run. Of course, it's going to take you some time, a couple of months at least to learn, but it's much more worth it for you to be in a professional service and save money in the long run by not doing the same mistakes over and over again, like most of the retail traders. And most importantly, for those that believe in there is a magic formula or a robot that you can do the copy trading and you can make money, this is just fake. Okay, you have to understand those robots, they are programmed by somebody who maybe he has found something in a specific market cycle or dynamic, which obviously when this is going to end and the market will change dynamic and cycle, this robot will be a big failure. You're gonna lose all your money. So you need to understand that you need to educate yourself properly how the market works, how you can trade it, and do not look for the easy way and end up in the same rabbit hole by being enticed by those fake products that somebody is looking to sell you, and they're trying to show you that it's an easy way and you can depend on them, right? So thank you so much for watching. Stay tuned for the next Friday's third episode. We will cover more things about the market, and we're also going to have a look at certain other things which are very important for the educational series. So stay tuned, have a good weekend, and I'll see you next week.